typically, hostile takeovers tend to focus purely on shareholder value creation. So they would ignore operational synergies, they would ignore expansion, technical R&D, that kind of stuff. So that is why it's normally almost a capitalistic discussion, which is why generally hostile takeovers have a negative connotation in the market, because really there you're looking to say, currently your company's share price is trading at, say, at 50 Rand. We are looking to make you an offer at 55 because we can believe we can better manage the business or give it more value. And you tend to find that a hostile takeover is attempted where there is perceived sort of trading at lower than market cap value of that particular entity, because otherwise there wouldn't be room for you to entice an existing shareholder to let go of their shares. So if the share is trading at a good price and it's seen to reflect the true asset and market value of the business, there's little room for you to maneuver on a hostile takeover. But where there's perception that the share price is trading at slightly below, that is where there is room for you to entice an existing shareholder and say, you know, look what, let me give you an extra 5 Rand for this price, because chances are it will go below 50 already.
How successful have hostile takeover bids been in South Africa as compared to other countries around the world?
In most emerging markets like South Africa, you tend to find that a lot of the shareholders are more long-term in terms of their outlook, and they chase less short-term gains on the capital growth of the share price. So which is why typically in South Africa, most of the attempted hostile takeovers have not been successful. You think back historically, the Nedbank, Standard Bank attempt that didn't go through because at the end of the day, the shareholders that were in place had a much more long-term view. So you find more in capital active markets like the US and some in London, where a hostile takeover tends to have a better chance of success, because your shareholders in those type of markets are looking for a very quick short-term return.
How do hostile takeover bids normally affect employees concerned in those companies as well as consumers?
Typically, consumers tend to benefit because most of the time a shareholder taking on board and a hostile takeover will become a majority controller, which means they would look to drive efficiencies, look to improve products, look to improve a sort of distribution network of that particular service so that they can gain more revenue. So there's normally quite an aggressive marketing sales drive to ensure that the turnover of the company increases, and the company looking to do the hostile takeover typically has a view, or what we call a hypothesis in our transactions world, that says I can drive up turnover and sales on the back of this asset by doing 1, 2, 3 things. So consumers tend to benefit. From an employee perspective, it's typically not a good story, because most of the time, if you are doing an aggressive hostile takeover, you tend to need to sort of borrow some money to actually make and sweeten the purchase price for the shareholders, which then means you need to drive what we call cost efficiencies once you've taken over the business. And typically cost efficiencies means you need to reduce overheads, and one of the biggest overheads is fixed costs like employee salaries. Which is why most of the time unions are never very much for hostile takeovers, and which is why we look at emerging markets like South Africa. Most of the failed hostile takeovers where unions, management, and the board were able to then put forward a compelling case to the existing shareholders why they should retain their shareholding and not sell off.
The names